So, Jeanine, a disappointing number in your mind coming in at 3.9%. Of course, we did expect a bit of a decline because December is naturally a very strong month.
Well, yes, December is a strong month, but December was particularly strong. So I think I did caution when I was on the program a month ago that we really cannot expect January and February to be strong after a month like December. It's a bit of a hangover that we're going to see with the consumer for the first 2, possibly 3 months. Although having said that, I am starting to hear from the retailers that March is trading slightly better. So we were expecting that, and I think, you know, we'll get out the other side.
I mean, with regards to the overall consensus number, it seems that it definitely didn't hit anywhere close to what people were expecting. And we know with regards to the overall health of the consumer, this is also going to give us a very strong indication as to where monetary policy could go.
Yes, I think so. And as we speak now, we definitely are starting to see some further push-outs of interest rate hikes. Most economists out there are busy talking now the middle of next year for interest rate hikes, where previously it was the end of this year. So yes, definitely, I think monetary policy will react on these kind of numbers, and certainly if we see them continue like this through the year, it will definitely push out interest rate hikes.
So let's look at some of the sector performance. We saw general dealers, which account for around 38% of the overall weighting, coming in at 5.7% growth year on year from that 8.7% growth in December. It seems that general dealers are still experiencing positive momentum.
Yes, although, you know, they are still slightly down. I think the only category that wasn't down was the hardware pen. So general dealers is sitting more comfortably than clothing, where I think the real, well, one could say catastrophe happened. I mean, the growth rate there has dropped from, on a nominal basis, from close to 15% to 5%. So basically a 10% drop in growth. But really, clothing is where the real spend is in December, and that's also where the real push was in December. I think a lot of the clothing retailers were busy pushing a lot of credit at the consumer, and they were taking it and they were spending, and we saw that come through almost all the retailers, the listed retailers' numbers, that December was particularly strong. So once again, January and February are not particularly strong.
I mean, Jeanine, you mentioned the overall clothing, footwear, leather goods, textile space, and just looking at the year-on-year numbers that I've got in front of me, 11.5% in December, dropping to 1.7%. What kind of recovery are we expecting even for the month of February and March, Jeanine? You were saying that retailers are saying things are looking slightly better. How much better could they actually get from this dismal number?
I would expect that February would be very similar, probably maybe 1%, but March we would start heading up towards the 4-5% real growth again. So, and I think that's where we're probably going to settle for most of the year, that we'll be sitting at about 4-5%. The 8% and, you know, the incredibly high percents we saw at the end of last year are really not sustainable.
Let's also take a look at, I mean, we keep talking about the unsecured loan space and that increasing dramatically, even in the month of January, because we saw a 30% growth year on year in unsecured lending in that month. And perhaps quite evident in the household furniture and appliances sector, where we saw, yes, a drop from 7.5% in December to 4.7% in January. Is this a concern for you that a lot of the unsecured loans are coming through and evident in the growth environment that we're seeing within this durable goods space?
Yes, I think they're slightly two different stories, but yes, the unsecured loan is certainly taking away from our furniture retailers' lending books, so they're not managing to grant credit. Whether it's actually impacting on their sale of furniture, I'm not quite sure. I think that might be quite a different thing, that furniture sales, well, there's deflation in that category, so it's really hard to get a positive sale out of it, or at a nominal level. But on the unsecured space, certainly we are a bit concerned that kind of lending going into the consumer is firstly going to put a lot of pressure on them down the line, but also is dragging away from what was previously the furniture retailer's business.
Well, Jeanine, you know, I speak to a lot of the retailers out there, and within the durable goods space, within the furniture space, and even to some extent within the food space, we're still seeing a large amount of deflation that is coming through. And when you see what has happened on the food and beverage side of things, consumers not buying as much as what they bought in December, and despite the fact that retailers are coming out and saying, well, we're not putting through the cost pressures that we're experiencing because we want to ensure that we keep sales up. Is this also a worrying factor, given the fact that consumers are still not as robust within the space, even experiencing the very high level of inflation?
Yes, I think that we are going to see more and more of that through this year. Food inflation is something that really impacts the individual's pocket, as does the fuel price. Those are probably the two biggest biggest factors. And on the middle income consumer, where the mortgage bond is perhaps not that important, but really just day-to-day living expenses, they are really going to see, well, they are currently having a bit of a rough time with food inflation, and we are seeing, well, we're seeing that on the durable side they're not spending, we're seeing on the clothing side that it's pulled back, and I think we will continue to see it through a lot of other categories. We seldom see it really pull back on the volumes in food. We seldom see people eat less because they're under pressure, but we do often see them trade down to slightly cheaper products when they're under pressure.
So Jeanine, and again I allude to a lot of the retail CEOs out there and saying a much better environment that they're experiencing. Some are still worried about deflation in certain products and certain sectors. And then the share prices are telling us a very different story because it's still very high. We're waiting to see when we'll actually start getting a little bit of pressure coming through there. It's not happening.
It really is quite difficult to tie up what happens to the share prices in the short run anyway to what's happening in the long run. I think in the long run, even if we're sitting with a year of pressure ahead for the consumer, we are not necessarily looking at a downturn in the consumer. The South African consumer is still an emerging consumer. Globally, it's still considered a high growth consumer. And the share prices are reflecting that, because a share price is really a discounting of a long period, not just the 1 year ahead. So I think what we're seeing right now, all the shares are running, not just consumer, but even so, our retailers do appear to be a bit expensive. I think that the thing is that everybody's making a call on the emerging market consumer that we have here.
Jeanine, when it comes to the overall health, we've got very low interest rates. We're sitting at 5.5% on the repo rate front. Are you expecting any movement to the downside on the interest rates this year, given the fact that core inflation is pretty much still in target?
No, we have just pushed out our interest rate hike to the middle of next year. So we are definitely not expecting anything this year. Obviously, unless there's an unexpected shock, which would most likely come from the currency. If there was a massive crash in the currency, that could change our scenario. But right now, given that we are not seeing a lot of strength, firstly in the consumer, but mostly in manufacturing, although I must say the last data point showed manufacturing a bit stronger, but in general, manufacturing hasn't been strong. And really the economy as a whole, the construction sector is very weak. Most sectors in the economy are still incredibly weak, and we don't expect interest rate hikes. Also because the rest of the world is really quite weak, and the pressure coming from Europe is going to be seen in our South African economy.